Today, we are diving into one of the most powerful wealth building strategies in Canada, the Smith Maneuver. And to help us do that, I am joined by Nick Cox, the National Director of the Smith Maneuver. Nick has been on the front lines of teaching Canadians how to turn their mortgage into a tax deductible investment tool. A part of that is also teaching real estate professionals, tax professionals, how this strategy works so they can help their clients as well. The Smith Maneuver helps families accelerate wealth creation, pay down debt smarter. So, whether you're a homeowner, an investor, or just curious about using your mortgage the right way, this is going to be a fantastic conversation.
This is the Saskatchewan Real Estate Podcast.
Nick, to start us off, welcome to the Saskatchewan Real Estate Podcast.
Thanks for having us on, Ronald.
All right, Nick, let's just start us off with a real softball here. What initially drew you to this strategy?
Okay, I'll be honest. I always growing up, I always thought I was going to be a financial planner, and so over the last 25 years, I've kind of bounced between financial planning and mortgage broking. And as you can tell with the accent, I'm not from around here. So when I relocated from Australia to Canada, basically 10 years ago, I thought, do I go down the financial planning path or the mortgage broking path? And at the time, I originally decided to go down the financial planning path. So I was doing my CFP designation. I was working with Canada Life. And but after a few years, I realized that I wasn't. I was always a better mortgage broker, and I liked it more. So I switched hats again, like I've done a few times over the years, and moved back into the broking space. And it was definitely the right move. Shortly thereafter, I came across the Smith Manoeuvre, and I'd never heard of it before. But once someone directed me to the book, and I said, what do you mean you convert your mortgage to a tax deductible investment loan? Like I hear what you're saying, but I don't really understand it. I read the book, and I quickly realized, I was like, this is actually the best financial strategy I'd ever come across in the context of mortgage advice, but it was really solid financial planning. So what's that saying? If I was zigging, now I'm zagging. There was kind of a line drawn in the sand. Is once I became aware of what the Smith Manoeuvre was, I kind of just pivoted my entire business and focus on sharing with Canadians how a mortgage is so much more than something you need to just get into a house. It can actually be a central piece in your financial plan. And so I've been digging into helping clients, but now also other professionals, in how to integrate that into their planning modalities.
I love what you said there about, I hear what you're saying, but, I just need a little bit more information. I find that's where lots of people get with this, that maybe they've even heard someone mention the Smith Maneuver, and they've maybe watched a video or two, and they kind of just need a bit more information on that. So let's just quickly transition into that of like, what is the Smith Maneuver?
Yeah. It's funny, and I'll address your question kind of two ways. One is, the Smith Manoeuvre is it's a recognized brand name. When Fraser came out with the book, Is Your Mortgage Tax Deductible, in the early 2000s, it caught on like wildfire. But what I've also discovered is, even when people are like, oh yeah, the Smith Manoeuvre, their understanding is often very surface level. And the truth is, it's actually quite deep in terms of the planning you can go to. So I'll explain like the foundational element of the Smith Manoeuvre. In Canada, would you agree, Ron, that when you go, I might make this a little bit conversational, when you go to do your taxes at the end of the year, and if let's say you own your primary residence and you have a mortgage on it, the accountant doesn't allow you to deduct the interest against the interest costs you've incurred on your mortgage. You don't get to deduct that against your personal income, do you?
You certainly don't.
Right. So Fraser Smith came up with a way that there's actually a process you can go through to make your mortgage interest on your primary residence tax deductible. And the mechanics of this, it's kind of subtly beautiful. So I'll kind of just talk you through the mechanics of it. Every month, you make a Canadian will make their mortgage payment, and that mortgage payment is comprised of a portion of principal and a portion of interest. The interest goes to the bank; they keep that. The principal actually reduces your balance. Now, what allows this strategy to work in Canada is the fact that we have what's called the re-advanceable home equity line of credit, which basically means as you pay down the mortgage on the balance on your mortgage, you have a line of credit facility, and the limit increases as you pay down the mortgage. And so as you make your regular mortgage payments, and each month it opens up room on this credit facility, the process of the Smith Manoeuvre is we take that principal reduction out of the line of credit and we invest it. And as long as we invest with the reasonable expectation of generating income, so you can't go out and buy Bitcoin or gold, but you can buy something that has that reasonable expectation of generating income, then the interest on the borrowings is tax deductible. So two things immediately happen as soon as we draw money from the line of credit to invest. First of all, we've created a tax deduction. And at the end of the year, that tax deduction will create a refund or a tax savings. And so the first thing is we take that tax saving on an annual basis and use it as a prepayment on the primary residence mortgage. That creates more room in the line of credit, and we repeat the process. So the first element is an annual tax refund or tax saving, and we use that to prepay the mortgage, and we reborrow that and invest it. The second thing that's happening is that we're instantly repurposing the principal into an investment that ideally is going to be increasing in value. So there's no debt equity. We're repurposing principal into an investment. And over time, the fact that we're taking that principal each month and redistributing it to something that's going to increase in value while simultaneously creating tax effectiveness with the tax deductions, over the long span of time, these can turn out to be pretty large numbers. Oftentimes, like we're talking multiple hundreds of thousands of dollars of additional wealth over the original amortization, or really shortening the amortization on someone's mortgage. And the subtle beauty to this whole process is that the whole thing has a self-funding mechanism to it. So no additional cash inputs are required by Canadians in order to run the strategy. Now, there was a lot of words there, but essentially I'll go through it quickly. Primary residence mortgage payment is made, principal readvances into your line of credit. We reborrow that to invest, create tax deductions, build a portfolio. The whole thing works without any additional cash inputs. And that's what's called the plain Jane, right? Which is the foundational process of the Smith Manoeuvre. I won't go into it right now until you ask me, but there's then what's called accelerators, which are different ways that we can layer on and speed up the process. Oh, and I should say this whole thing is about converting debt. So it's converting that non-deductible debt on your home into a tax-deductible investment loan. And the Smith Manoeuvre, plain Jane, is the foundational process to do that.
Let's quickly expand upon that, because I think a lot of the pushback that people have against the Smith Maneuver is that I don't want to leverage against my house. There's the thought, I'm all of a sudden now I'm borrowing money from the home. Expand upon that, Nick, because you said it correctly, that it's debt conversion, not necessarily a leverage.
This is a great question, because it is and it isn't leverage. And what I mean by that is that whatever risk is assumed for taking on debt has already been assumed when you've got the mortgage. The version of the Smith Maneuver that I just explained to you requires you to take on not a single cent of debt above what you already have. All that's happening is we're just converting the debt that you already got. And then instead of using the principal to pay down the balance, we're actually just redistributing that to an investment. So technically, in the eyes of the financial planning industry, it's deemed as leverage, because if you take money from a credit facility and you invest it, you're borrowing to invest. The other side of it is, well, I've already borrowed the money. I'm simply adjusting the way that I service that debt. And instead of using the principal to reduce the balance, I'm going to maximize the benefits by taking the principal and investing it. So technically debt conversion, we're not increasing leverage above what's already been borrowed, but also technically leverage because we're borrowing from a credit facility. It kind of sits in this interesting, I guess it's a bit of a conundrum, where someone sits, right? Because it's kind of a bit of both.
Yes.
Yeah.
In a past life, Nick, I used to be a cook. And so let's put on our chef's hats for a second. If we look at the ingredients that you need to put the Smith Maneuver together, if we're putting together our pasta dish of Smith Maneuver, what are the key ingredients that a Canadian would need in order to execute this strategy?
Okay, first of all, you need to have at least 20% equity in your home. So in order to get the product that allows this whole process to take place is the re-advancing credit facility. And you can only qualify for one of those kinds of products if you have, it's what's called conventional, if your loan to value ratio is 80% or below. So that's the first thing, is that you need to have 20% equity in your home. The second thing is that you need to be with a lender that has the right product. that has a re-advancing home equity line of credit. Most truth is, like, a lot of lenders don't have the right product. You're typically looking at your main players like your Scotia, TD, Manulife, and then RBC, CIBC, BMO. The larger lenders, there are some smaller credit unions and smaller banks in the different provinces that might have the right product, but you just want to make sure that you've got a credit facility that re-advances as you pay down the mortgage, and that's really it. That's the only requirements. Um, yeah, and then you've got the mechanics of what you need to start the strategy.
And not to get too far into the weeds, but this is where some people can kind of get tripped up to say, I understand this process. I'm going to venture off and do this on my own. And I think to maybe just do a quick plug of why you'd maybe want to use someone who is Smith Manoeuvre certified is that each of those lenders is going to have a slightly different flavor in how they treat those lines of credit. So without getting too far into the weeds, Nick, just
Yeah.
talk us through why some of these are different, and how working with someone who understands all of these can be beneficial, because you might have a lender with a big blue bank, and maybe they don't offer the right prepayment privileges, or it doesn't fund the line of credit in the same way. Just quickly on a high level view, talk us through why each of these is different.
Yeah. Well, like, I mean, without going into the weeds, from on the surface, you go to a bank and you're like, oh, they've got a re-advancing line of credit product. Great. But if a mortgage broker, or more specifically a Smith Manoeuvre certified professional, which is generally who I'd suggest you want to speak to if you want to do the strategy, because you want to go with someone who knows what they're doing. There's subtle nuances between lenders and the way the product actually functions. And so depending on the version of the Smith Manoeuvre that is being executed, you might find that Scotia is more relevant, or maybe TD is, or maybe RBC is a lender to avoid because of how their prepayment rules work. So I think it's just important to make sure that you're consulting with someone who understands, one, the Smith Manoeuvre, and then two, the subtle nuances in the HELOC products, because the difference could actually substantially impact the way that you execute the Smith Manoeuvre. I could go a lot deeper than that, but I think we should probably keep it, surface level.
That's perfect, because we could probably go an hour just specifically
Yeah.
on that topic with the different lenders. Walk me through, Nick. Someone's like listening or watching to this, and they're like, geez, this sounds interesting. How do I know that I'm a good candidate for something like this?
Yeah. Well, I guess, there's a few different options you have available to you. I always think that it's best to be as educated as you can be around something that you're looking at. So there's for starters, there's two great books that are available. So there's the original classic by Fraser I think it's called Is Your Mortgage Tax Deductible, written in the early 2000s. His son, Rob Robinson, wrote a follow-up to the classic called Master Your Mortgage for Financial Freedom. So if you're inclined to read books, then you can go and read the books, and you'll have a pretty good basic understanding of the way the Smith Manoeuvre works. Second to that, or even before doing that, if you wanted to sort of see how this might apply to you, is go to the official website, which is just smithman.ca, and you can actually get connected to a Smith Manoeuvre certified professional, so a licensed SMCP. Now, it's important to note, the SMCP, it's a designation, but it's not supposed to be a designation like a CPA or a CFP. These people have studied for years around their specific fields. Seeing a Smith Manoeuvre certified professional just ensures that you as a Canadian are going to a financial professional, whether that's an accountant, a realtor, a lawyer, a mortgage broker, or a financial planner, that has deeply trained on the Smith Manoeuvre and really understands every layer to it. And so by going to the website, you can actually register, an inquiry to be contacted by an SMCP. And so what will then happen is we've got around 200 licensed SMCPs across the country, across 7 different professional classifications. So you'll be directed to an SMCP in your area, and also based on the professional classification that you want. So you might be an investor that's really savvy and really understands stuff, but you want to speak to a CPA. Or maybe you're completely green and you're like, I need to speak with everyone. I want to speak to a CPA, a CFP, and a mortgage broker. So you can get connected to an SMCP, and that SMCP or those SMCPs will reach out and essentially do a deep dive into your scenario, which version of the Smith Manoeuvre is most relevant, and show you the results you can produce. There's a proprietary calculator that allows an SMCP to assess a Canadian's particular portfolio structure when it comes to whether they've got one property or other ones, and then project out how the Smith Maneuver can work for them.
Wonderful.
Real estate investing does not have to be a full-time job. Randall, Hoeber, and Boys Group Realty provide complete property management services in Yorkton and surrounding areas, allowing investors to enjoy passive income without the headaches of day-to-day management. From finding tenants to handling maintenance and rent collection. Whether you own a property or are just getting started in the market, Randall, Hoeber, and Boys Group Realty makes it simple. Call Randall Hoeber at 306-782-1323 or email info@ralixenterprises.com to take the next step towards hands-free real estate investing. Your property, our expertise. Whether it's your home, business, or farm, Pioneer Solar and Renewables has you covered. As leaders in residential, commercial, and agriculture solar solutions, they make clean energy easy and affordable. Visit pioneersolarenergy.com or give them a call to begin harnessing the power of the sun today. Are you investing in real estate? Let Krishna with Boys Group Realty take care of everything. Finding properties, purchasing, renovations, leasing, and management, leaving you to focus on building wealth. Whether it's a single rental or an entire portfolio, serving Saskatchewan and surrounding areas, helping maximize cash flows and minimize stress. If you're looking for an expert to manage your investments, reach out today, home@meetkrishna.ca.
And let's talk about those different versions, the accelerators that you can use within the Smith Maneuver. And one that I particularly love is the cash down one. But Nick, just on a high level, if you can, just take us through some of the different accelerators that a person could use above and beyond just the plain Jane version of the Smith Maneuver.
Yeah, and I totally agree. Like, my favorite accelerator of the Smith Maneuver is the cash flow dam. I would go so far as to say that half of the implementations that I've done have been specifically around this one accelerator. So there's 5 in total. There's the debt swap, the cash flow diversion, the cash flow dam, the drip, and the prime the pump. And I'll briefly explain each one. The debt swap, would you like me to explain each one and then we can create context?
Please do, yes.
Okay, so the debt swap is essentially, let's say you've got someone that has a mortgage and they also happen to have $100,000. Let's say, actually, I'll make it simpler. $500,000 mortgage and $100,000 non-registered portfolio. So these people have, outside of an RSP or a TFSA, they've accumulated some savings. So they've got 500 in debt, 100,000 in assets. So the debt swap is quite simple. The idea is you would sell the 100,000 non-registered portfolio, use it to pay down the mortgage to 400, re-borrow it through the HELOC, and then reinvest it in a similar asset that produces income. So you end up in the same place that you started, right? 500,000 in debt, 100,000 in assets, but it's broken up in 400 and 100. And so you're basically, in a single move, you've made $100,000 tax deductible. The whole process of the Smith Maneuver is gradual debt conversion over a period of time. The debt swap is a very fast way to convert a large amount of debt in a single move. One consideration is, well, there's going to be taxation impacts on selling the asset. Possibly, yes. That's why you would always speak with your financial planner or accountant. But oftentimes, the long-term tax savings by doing that move will far outweigh that single event that happens when you do it. Just a quick example, I had a client that I did a debt swap on a purchase for, and we, just by doing that, the tax savings reduced their amortization from 30 years to 22. Without doing anything else, by applying the debt swap on an inheritance at the time of purchase, we knocked 7 to 8 years off their amortization. And if they went to a bank or just a normal mortgage broker, like, they wouldn't have told them that. They would have said, oh, okay, keep that money separate. I think it's important to note that, little side quest here, Ronald, if I may. I think it's important, like, it's really expensive to live as a Canadian. High taxes, high cost of living. Anything we can do to create efficiencies that where it doesn't require us to earn more to create better outputs. I think that's one of the things that really attracted me to the Smith Maneuver, is that there's a subtle beauty that it doesn't cost you anything to implement, but it produces a saving with reducing tax and interest and creating more wealth for you in the future. So that was a little side quest, but that kind of explains the debt swap. The cash flow diversion can be applied in a couple of different ways. So this might be going through you've got a car loan over here, and you've got some credit card debt here, and you've got your mortgage. So refinancing, consolidating all of your non-deductible debt, which reduces down your mortgage payment. But then actually, continuing to pay what you were before, like with the credit card payments and the car loan payments, towards the mortgage, which creates more room in the line of credit and allows you to invest more. So you're kind of increasing the efficiency of managing your debt, consolidating it all into a lower interest rate, but then continuing to pay what you were and then redistributing that to the actual Smith Manoeuvre plan. That can have a pretty powerful impact. And another element of the cash flow diversion is just maybe you're already contributing $100 a month or $500 a month to an investment plan. Hey, run it through the Smith Manoeuvre first. So instead of just going directly from your income to the investment, run it through your mortgage and sort of apply that additional layer to it. That's the cash flow diversion. The cash flow dam, also commonly referred to as rental cash damming, very powerful because it's really about, and one of the reasons, you're a mortgage broker, I'm traditionally a mortgage broker, why it's really great for mortgage brokers is because a lot of our clients have rental properties. Most of the time when people get their rental income, the rental income comes into an account and then they pay the rental expenses. That account is either their normal account where it gets mixed in with everything else, or maybe they've segmented an account that's just for the rental property. There's nothing inherently wrong with that, but there's a massive missed opportunity. So the cash flow dam is a process of taking gross rental income, using it as a prepayment on the non-deductible mortgage. That creates substantial room in a credit facility. We reborrow that to service rental expenses. Now that, because rental income is often thousands of dollars a month, this accelerator can just used on its own can save clients 5, 10, 15 years off their amortization and multiple hundreds of thousands. And I guess this is probably a good point to mention is that the Smith Manoeuvre, I like to think of it as 6 levers of debt conversion. You've got the plain Jane and these 5 accelerators, but they can be used in isolation or in combination with each other. The cash flow dam is something that's often used in isolation. So that's a really powerful one. Generally, when you buy a stock portfolio, it produces dividends. Those dividends can sometimes be used to buy paid up additional units. Instead of doing that, the idea is you take the dividend as cash, prepay the mortgage, flow it through the line of credit, rebuy an asset. So you're taking the dividend and using it to convert debt as opposed to just buying paid up additional units. And all of those accelerators I just went through, Ron, require no additional cash input. So a Canadian can apply everything we've gone through so far without any change to their budget at all. And that's rare, right? You go to a financial planner and you want them to help you with something. You have to find a delta, right, in your income and expenses to invest. This doesn't require that. If you're paying your mortgage, you can do these things. And that's pretty powerful. The last one is the one exception. It's called prime the pump. And as the name suggests, you're priming it. So this is an example where someone might have unused equity in their home. They can kind of jumpstart the plan by borrowing from the line of credit to invest. And there's not enough, we haven't yet described how the HELOC interest is serviced. We haven't gone down that rabbit hole, but suffice to say that if you're jumpstarting the plan with a lump sum, the strategy can't handle the interest cost on that itself. So that's where you'd need to cover the interest cost on your own. And that's done through paying each month a prepayment on the primary residence mortgage. Where appropriate, the prime the pump, the numbers are quite crazy because if you're starting the plan with like $100,000 investment instead of a $500 monthly pack pre-authorized contribution, the speed at which that portfolio grows over those 20, 30 years is quite remarkable. And so I guess, to kind of summarize that is it's 6 levers of debt conversion. Each one can be used in isolation by itself, or they can be combined in any combination. And an SMCP has the skills to identify which of those accelerators are appropriate in what combination to use and in what order. And so what I found, and I'll finish on this note, Ron, is that when a lot of people say, I understand the Smith Manoeuvre, they might understand like a portion of the plain Jane. Very few understand the whole picture of the 6 levers and how they interact with each other.
That was perfect. When you're on a roll, Nick, I like just to let you talk because you did a perfect job of kind of explaining those different aspects. And I think the really important thing that you kind of highlighted with this is that the Smith Maneuver in concept is quite simple. You're debt converting non-deductible debt to tax-deductible debt. But within all of that are all these different scenarios where if you don't understand a portion of it or if you're not doing it correctly, can cause the strategy to not work the way that the people are hoping for. And so, connecting with someone or doing more research to make sure you fully understand is vitally important. And let's kind of wrap it up with that, Nick. If someone's watching this and they're like, God, I got to get more information about this. Do you guys have any resources outside of what you've mentioned, or where would you point people to
Oh yeah.
go if they're looking for more details?
The Saskatchewan Realtors Association supports over 1,700 realtors across the province. Their members provide expert insights to help you navigate the market. Visit sra.ca for monthly stats, industry updates, and to find a realtor near you.
Okay, so a couple of things. One, like grab the books, read the books. But if you don't want to do that, every month we do client-facing webinars. So there's a webinar that the Smith Manoeuvre organization does each month that's public-facing. Goes for about an hour and a half, and it's a deep dive into the whole Smith Manoeuvre program. There's also a short video series on the website you can register your interest for. Goes for about 25 minutes. It's broken down into a mini series, and it's curated by Robinson Smith, the son of the founder. So that'll give you an idea of the mechanics. I think obviously connecting with an SMCP, because that's someone who's kind of decided, hey, this is something that I want to really focus my business on. I think between the live webinar, the short video series on the website, the books, and just connecting with an actual professional, you're going to have the information you need to work out if it's applicable to you.
Brilliant. And just end us off, Nick. If someone's looking for more information on connecting with someone, just remind us of the website of where they would go.
Smithman.ca.
Okay.
I know that this is a YouTube interview. Can I riff for a second on one area that I just think is really valuable to mention?
The benefit of having your own soapbox, Nick, is you can kind of just do whatever you want. So yeah, riff away.
I kind of alluded to it a little bit, but I think the history here and why the Smith Manoeuvre may not be as prevalent as what it should be is that in 2008, after the global financial crisis, leverage became much harder for financial planners and investment advisors to advise their clients on, because up until that point, the Smith Manoeuvre was heavily integrated into financial planning, but the regulators sort of changed their view on leverage, and so it fell out of favor with financial planners, even if they wanted to do it. And I help a lot of planners do it themselves, by the way. The dealer groups and the compliance officers kind of made leverage, because it's technically deemed leverage, it made it harder to advise clients on. The other thing that we've seen since 2008 is skyrocketing property prices. So the percentage of disposable income that a Canadian has to use to service housing costs compared to 2008 is huge. So we've got this situation where the financial planning industry at large stopped advising on mortgage strategies, and housing costs have skyrocketed. Traditional financial planning doesn't adequately address mortgage debt. And so you've got the Smith Manoeuvre, which is this remarkable strategy that's kind of been there the whole time, but accountants are accountants, financial planners have their hands tied, and mortgage brokers are often loan officers. So you've got a strategy that essentially has elements of each profession, right? It's a tax strategy, it's a solid financial plan, but it has to be executed through a mortgage strategy. So it's kind of, I think, to a little bit slipped through the cracks. But the relevance now compared to, this has been around since 1983, the relevance now in the current economic climate for Canadians, I think, is more relevant than it's ever been, ironically, because most people are just like, I just need to not go backwards monthly. I just need to be able to pay my mortgage. So they're actually really struggling to save for the future. This is something that allows you to save for the future without having to find additional cash inputs. And that is something that is quite remarkable. I wrote a piece recently where I said something along the lines of, it's just, you're squeezing as much orange out of the juice as you can. And if you've got something in front of you that doesn't cost you anything, you don't have to find new money, but it's going to save you taxes and interest, like that's a string worth pulling on. So I would say, for any of your audience that's watching it, dig in and see how it can help.
Very well said. I'm not sure if it's the Australian accent or just chatting about the Smith Manoeuvre, but you do make a lot of sense with this, Nick. And I do think it is an exciting strategy for a lot of people. So I really appreciate you coming on the podcast today, sharing your knowledge on this. It's always great to connect with you, and I really appreciate it.
Thanks for having me on, Ron. Take care.
Thanks for checking out this episode of the Saskatchewan Real Estate Podcast. Until next week, my name is Ron Quaroni, your Saskatchewan mortgage professional. Bye for now.